Imagine this. A company, well, deliberately shrinking itself, shedding products, slashing costs, all really in a desperate fight just to survive.
Yeah.
And the stock, it's down over 98% from its highs. We're talking about Aterian, Inc., ticker ATER.
Hmm.
So the big question is this a deep value turnaround story waiting to happen? You know, a phoenix rising from the ashes?
This is something else?
Or are we actually watching the final chapter for what was once a pretty promising e-commerce hybrid? Today, we're going deep. We're going to unpack Aterian and try to answer that question for you.
Welcome, everyone, to the Deep Dive. Our goal here is simple. Dissect Aterian from the ground up.
Yeah.
We're approaching this like fundamental value investors would.
Right.
We've pulled together insights from a really comprehensive deep stock research report,
Yeah.
hoping to give you the clearest, most actionable picture we possibly can.
And just a quick note before we dive in all the financial data, the market metrics, everything we discussed today, it's all current as of June 24, 2025. Back then, Aterian's share price was sitting at $1.46.
Okay, and to help you follow along with this somewhat complex story, we've broken our deep dive into two main parts.
Makes sense.
First, we'll tackle the core business itself, look at the management team running things, and check the company's financial health. Or lack thereof, maybe.
We'll see.
Then in part two, we'll zoom out a bit. We'll look at broader market sentiment, who actually owns the stock, the key risks involved, and then try to bring it all together in a final conclusion.
Okay, sounds like a plan. Now, before we get started, if you find these deep dives valuable, please do remember to like and subscribe to Stock Analytics AI.
Yeah, that really helps us out.
It does. And for just €4.99 a month, our members get priority access to these in-depth analyses on specific tickers. We're actually planning over the next few months to cover all of the S&P 500 stocks, giving members exclusive first looks.
That's a huge undertaking.
It is. And hey, if there's a particular company you want us to tackle in a one-off deep dive just for you, you can always drop us a super thanks. All right, let's kick off part one of our deep dive into Aterian. Chapter 1. Business analysis. So first things first, what does Aterian actually do? They call themselves a technology-enabled consumer products company.
Right. And their model, it's kind of twofold. They try to build their own brands organically, but they also acquire existing e-commerce brands. The idea was to leverage tech and shared operations across everything.
And historically, where did the money come from?
Well, historically, it was overwhelmingly Amazon US. I mean, a staggering 88% of their 2023 revenue came from just that one channel.
Wow, 88%. That's opposite concentrate.
Extremely. But they've definitely seen the risk there. Their newer strategy, this omni-channel approach, is all about diversifying. So expanding to their own websites, direct-to-consumer, getting onto Walmart, Target's invite-only platform, Target Plus Air, and even trying out Temu.
Temu, interesting. Okay, so they went through this big strategic shift, something called SKU rationalization. What does that mean for what they actually sell now?
Yeah, SKU rationalization, basically it means cleaning house, getting rid of products that weren't profitable or just didn't fit anymore.
Streamlining.
Exactly, streamlining. So after that process, they've narrowed their focus down to just 6 core foundational brands.
And what are those?
Okay, so you've got the one everyone knows, Squatty Potty. Then Home Labs, that's home appliances, air quality stuff. Mueller Living is kitchen appliances. Persteam does steam cleaning. Garment Care. Healing Solutions is essential oils. And Photo Paper Direct, which is a bit more niche.
Quite a mix still.
It is. And those categories mean there's definitely some seasonality in their business you need to keep in mind.
Now, what's really striking is this dramatic pivot in their whole market position. They used to be Mohawk Group, right?
Yeah.
All about aggressive growth, buying up companies.
It was the old playbook, yeah. Growth through acquisition.
But now, as a Charterian, they're a microcap company. We're talking a market cap fluctuating somewhere between, what, $9.3 million and $12.8 million back in mid-June 2025. What does being a microcap really mean for investors listening?
That's a really important point. Being a microcap, or honestly even a nanocap at this size, it's not just about being small. It signals significantly higher risk.
Okay.
You're looking at potential for extreme price swings, lower trading volumes, which means liquidity can be an issue. Big institutional investors, they typically steer clear.
So they're kind of off the radar for the big money.
Largely, yes. And their focus now, it's completely shifted. It's all about stabilization and simplification, trying to find a path to profitability with a much smaller, more manageable set of brands, rather than just chasing that top-line growth like before.
And their value proposition. To consumers, it seems pretty simple. innovative, affordable stuff online.
Right.
But for investors, the story used to be different. It's all about their proprietary tech, AME, wasn't it? The artificial intelligence marketplace e-commerce engine.
That was the key differentiator they pitched, yes.
Yeah.
Their secret sauce.
But something changed there pretty fundamentally, right?
So it really did.
Yeah.
In early 2025, they basically walked away from that internal AME platform. They shifted to what they called a best-in-class third-party model using a company called Pipe 17.
Okay. Why?
Well, the stated reason was cost savings. It cut over $4 million annually from their operational costs. But it really made you question that original tech-enabled story.
Yeah, was AME just not working well? Or maybe too expensive? Or just not the core advantage they thought?
Exactly. It suggests maybe it was ineffective,
Yeah.
or perhaps just expendable when push came to shove financially. So now their narrative is much more about traditional brand management, not unique, cutting-edge tech.
Okay, so with that context, what's the wider e-commerce world like for a company like Aterian in 2025? What are big trends?
Well, the trends are demanding. AI-powered personalization. That's not a bonus anymore. It's basically a baseline expectation for recommendations, supply chain, everything. The omni-channel imperative is huge, too.
Yeah.
You have to be everywhere.
Right.
Your own site, DTC, Amazon, Temu, even places like TikTok Shop. And then there's logistics and sustainability. So customers expect fast, often free shipping, and increasingly look for eco-conscious brands.
But it can't all be smooth sailing. What are the major headwinds they're battling?
Oh, definitely not smooth sailing. You've got rising digital marketing costs,
Yep.
partly due to privacy changes making targeting harder. And persistent supply chain headaches are a big one. Think global shipping disruptions, geopolitical stuff like tariffs.
Yeah.
It puts enormous pressure on companies like Aterian.
A tough playground. And the competition, what does that look like?
It's brutal. The landscape is hyper-competitive and highly fragmented.
So lots of players.
Tons. Think of it like a giant online bazaar. Aterian isn't just competing with big established companies like Helen of Troy or Newell Brands. They're also fighting against, well, countless smaller private label sellers, including sometimes the very same contract manufacturers in China who make their products. They might be selling similar items right there on Amazon or Temu.
Wow. So the battle is fierce on price, features, quality, reviews.
Marketing dollars, supply chain efficiency, everything. It's a constant fight for visibility and sales.
And regulation. Beyond the usual agencies like the CPSC, FTC, FDA, what's the big regulatory pressure point?
The most acute factor, without a doubt, is U.S. trade policy, specifically Section 301 tariffs on Chinese imports.
Because most of their stuff is made in China?
Historically, yes, the vast majority. So these tariffs aren't just some minor cost increase. They have the potential to completely wipe out their gross margins. It's become a central, maybe the central, strategic challenge and risk for them.
Makes sense why they're trying to shift sourcing then. Okay, what about barriers to entry? Is it hard for new competitors to jump into this space?
Honestly, they're extremely low. Platforms like Amazon, Shopify, and Temu, they've made it easier and cheaper than ever for anyone to launch products online.
Which leads to
Intense price competition. Sure, having established brands, a good supply chain, some scale, those things help. But they aren't insurmountable walls keeping new players out. Not at all.
So if that AME tech advantage is gone, or at least outsourced, what is Aterian's competitive edge today? What makes them stand out?
Well, brand strength is one potential area. The corporate name, Aterian, means nothing to consumers.
Right.
But they're acquired brands.
Yeah.
Some have real recognition. Squatty Potty is the obvious one. High name recognition, very unique product. Mueller Living and Per Steam also have some presence in their categories.
But you mentioned they're a microcap. That means they lack significant economies of scale compared to the big guys, doesn't it?
Absolutely. Their cost structure is under constant pressure. Rise raw material costs, shipping is expensive, marketplace fees keep going up, and then you layer on those tariffs.
So the recent cost cutting was really a necessity.
It was a direct response, yes. And in terms of network effects or switching costs, there really aren't any meaningful ones for their kinds of products.
People can just click and buy something else?
Exactly. Brand loyalty tends to be pretty weak. Purchases are often driven more by price, features, and, critically, those online reviews, rather than a deep connection to the brand itself.
And unique assets or capabilities now that AIM is off the table.
Well, outsourcing AB to Pipe 17 really throws its uniqueness into question, right? Was it ineffective, expendable? What's left is basically the team's expertise. They know how to manage e-commerce channels, and they have M&A experience from their Mohawk days, though that's obviously on hold right now while they focus on just surviving.
Okay, let's pivot now to Chapter 2, Management Evaluation. Let's talk about the leadership. The CEO, Arturo Rodriguez, came on board in June 2024. He's a CPA, finance background, and it sounds like his whole tenure so far has been about crisis management and a finance-driven turnaround.
That's exactly right. And the actions they've taken since late 2023 have been, frankly, drastic. We talked about the SKU rationalization, deliberately shrinking the company to boost margins. Then there was an aggressive cost-cutting plan announced in May 2025, aiming for $5 to $6 million in annual savings, which involve workforce reductions, never easy.
No.
And critically, this proactive tariff mitigation effort, they accelerated their goal to get less than 30% of their sourcing from China by the end of 2025.
So they're making tough calls.
They really are. This shows a management team willing to make unpopular, frankly painful decisions when they believe it's necessary for the company's survival.
And communication. They seem pretty open about the challenges, talking about tariffs, weak consumer demand.
They do communicate regularly through press releases, earnings calls. They don't seem to be hiding the difficulties.
There's a pretty significant but here, isn't there? Something investors really need to notice.
Yes, there's a major disconnect. On one hand, the company authorized a $3.0 million share buyback program back in March 2025. CEO Rodriguez even publicly said he thinks the stock is significantly undervalued.
Okay, that's a bullish signal usually.
Usually. But at the same time, if you look at the SEC filings from May and June 2025, key executives, the CEO Arturo Rodriguez, the CFO Joshua Feldman, the CTO Roy Zion Zahod, they're consistently selling their own personal shares.
Oof. So the company is buying, but the top execs are selling.
Precisely. That's a factual contradiction that's hard to ignore. It definitely raises a red flag for investors about their real confidence level.
Definitely something to watch. Okay, let's talk capital allocation. The old strategy, the M&A roll-up, is completely dead now. What's the priority for their capital today?
The number one priority now is just preserving the balance sheet. Any investment is highly targeted towards the existing core business.
So no more buying companies?
No. Capital is going towards, say, developing new products within those 6 foundational brands, like new launches for Steam or Miller Living. And, importantly, funding that omni-channel expansion onto platforms like Walmart.com, Target Plus Wood, and Temu.
And that share buyback we mentioned, $3 million authorized over 2 years starting March 2025.
Right, that's management's public signal trying to project confidence. But let's be clear on the flip side. Aterian does not pay a dividend.
And likely won't anytime soon.
Given the history of losses and the current focus on cash preservation for this turnaround, highly unlikely. Don't expect dividends in the foreseeable future.
So if we put this all together, what does it say about their return on invested capital, their ROIC?
Well, ROIC basically tells you how well management is using the money they have to actually generate profits. And for Aterian, it's been consistently deeply negative.
How negative?
Around negative 30% on a trailing 12-month basis, or TTM. Return on equity, ROE, also around negative 32%. TTN just means looking at the last 12 months.
And negative ROIC means?
It means they've essentially been destroying capital, not generating a return on the investments made. A huge goal of this turnaround has to be flipping that ROIC into positive territory.
All right, let's get into the numbers. Chapter 3, financial analysis.
Okay, first, market cap. As we mentioned, around $12.08 million as of our analysis date. That firmly puts them in the microcap, maybe even nanocap zone.
Which, again, means high risk, high volatility potential.
Exactly. Limited interest from big institutions. Now, looking at their 5-year revenue trend, it really paints the picture of that strategic shrinkage.
Right, the deliberate contraction.
Yeah. Revenue peaked in 2021 at $247.8 million. Then it dropped sharply, $142.6 million in 2023, down again to $99.2 million in 2024. And the TTM revenue for Q1 2025 was $94.2 million. That's the SKU rationalization effect right there.
But didn't they initially expect things to turn around in 2025?
They did. Management had guided for a return to growth, maybe up to $106 million for the year.
Right.
But, and this is crucial, they withdrew that guidance in May 2025.
Why?
Citing the massive uncertainty around those U.S. tariffs we discussed. So near-term revenue is now incredibly hard to predict.
Okay, so falling revenue. But paradoxically, the profit margins have actually improved quite a bit. That's
the surprising bright spot, yes. It shows the turnaround efforts are having an impact, at least higher up the income statement. Gross margin jumped dramatically from 49.3% in 2023 up to a really strong 62.1% in 2024. And it stayed solid at 61.4% in Q1 2025.
So the products they kept are more profitable.
That's the idea. The ATER Viyashi rationalization seems to be working at the gross profit level. Now, operating margin, they're still losing money there.
Still unprofitable overall.
Still unprofitable, but the losses have narrowed significantly. Operating loss went from a huge $76.2 million in 2023 down to $11.8 million in 2024. So the margin improved from negative 53.4% to negative 11.9%.
And net margin, bottom line.
Same story.
Yeah.
Net loss improved too, from $74.6 million down to $11.9 million. So yes, they've managed to stop the really heavy bleeding, but they haven't reached profitability yet.
What about cash flow? Free cash flow is often seen as the real health indicator.
And historically, Aterian's been consistently negative there too. Burning cash. They burned through $42 million in 2021, other $17.5 million in 2022.
Ouch. Any improvement?
They did hit a small milestone. They broke even on cash flow from operations in Q4 in 2024. That was positive. But unfortunately, the cash burn started again in Q1 2025 with negative $3.87 million in free cash flow. So no, they aren't sustainably cash flow positive yet.
Okay. So financial stability overall. Sounds precarious. No history of consistent earnings, right? Just losses for the last 5 years.
Correct. Significant net losses every single year. Their debt-to-equity ratio as of Q1 2025 was 0.84. Now, that's not ridiculously high on its own, but it's definitely concerning when you consider the ongoing losses and the fact that their equity base is shrinking.
Any positives on the stability front?
Well, their current ratio is actually pretty healthy at 1.74 in Q1 2025. That suggests they do have enough liquid assets to cover their short-term debts, which provides a bit of a near-term cushion.
Okay. And dividends, as we said, none.
None paid and unexpected.
All right, let's talk valuation. Since they have negative earnings, the standard price-to-earnings PE ratio is useless. It's negative. So how do you even try to value a company like this?
For unprofitable companies, a common relative metric is the price-to-sales, or PS ratio.
Okay.
Based on that market cap of around $12 million and the TTM revenue of $94.2 million, Aterian's PS ratio comes out to roughly 0.13.
0.13, that sounds incredibly low.
It is extremely low, way below its own historical averages. The 3-year average was 0.2, the 5-year was 0.5. It screams market pessimism about their future.
So the market is pricing in a lot of doubt. What about intrinsic value? Can we even attempt a discounted cash flow, a DCF?
We can attempt it, but you have to understand it's an exercise in modeling extreme uncertainty here. A DCF tries to estimate value based on future cash flows, discounted back. For Aterian, using an educational model, the resulting intrinsic value range is exceptionally wide.
How wide?
It suggests somewhere between $1 and $2.50 per share. That a huge range really reflects the binary nature of this thing. It's either going to work out potentially spectacularly, or it could very well go to zero.
And the assumptions driving that DCF must be incredibly difficult to pin down, like the discount rate, the WACC.
Has to be very high. Given the microcap status, the unprofitability, the huge tariff risks, and critically, that explicit going concern warning in their financial filings.
Explain going concern again, briefly.
Sure. A going concern warning from auditors basically means they have substantial doubt that the company can continue operating for the foreseeable future, usually the next 12 months, without needing significant new cash or a massive operational turnaround. It's a major financial red flag, signaling a real risk of business failure.
Okay, so high risk means high discount rate. What range?
You'd likely use something in the 15 to 20% range, maybe even higher. It reflects all those risks we just mentioned.
And growth rate projections, that must be even harder.
The toughest part. Short term, say the next 1-4 years, growth is completely up in the air, maybe 0%, maybe very low single digits, especially since management pulled their own 5-7% guidance for 2025.
Right.
For the terminal growth rate long term, you might plug in a standard 2.0% to 2.5%, reflecting overall economic growth. But even that feels highly speculative given Aterian's specific situation.
Yes. Okay, this brings us to part 2, deeper considerations. Chapter 4, market sentiment. This is where things get really interesting, maybe even confusing. Look at the market perception. The consensus analyst price target for ATER is somewhere between $8 and $8.16 a share.
Right. Compared to the $1.46 at price when we looked, that implies, what, over 450% upside?
Exactly. A massive disconnect. And the consensus rating is strong buy. But, and this is a huge caveat, how many analysts are actually covering this stock?
Very few. Sometimes maybe only one active analyst. So calling it a consensus is, well, it's not like the consensus on Apple and Microsoft. It's much less meaningful.
So the few analysts covering it are incredibly bullish, pricing in a near-perfect turnaround.
While the actual market price reflects deep skepticism, it's a huge gap. Now, looking at recent news, it's a mixed bag.
How so?
Well, positive or neutral news includes things like expanding onto Walmart's platform, launching on Temu. Those are potentially good steps.
Yeah.
But on the negative or cautious side, you've got the continued decline in revenue, and maybe most importantly, that withdrawal of the 2025 financial guidance, specifically because of tariff uncertainty.
So the overall market vibe is...
Cautious observation, I'd say. People see the company taking sensible steps to survive. But there's this sense that its fate might just be decided by these big macro forces like tariffs that are outside its control.
What about other market indicators, like short interest? Are lots of people betting against it?
Surprisingly, no. Short interest has been pretty modest, somewhere between 2.74% and 4.73% of the float.
Why so low, maybe?
It suggests that while buyers are scarce, it's not a prime target for dedicated short sellers either. Maybe the low price and high volatility make it unattractive for shorting.
And technically, looking at the charts.
The stock price, $1.46, is trading below its 50-day moving average, which is around $1.74. That signals a negative short to medium-term trend.
And the longer-term picture?
Even clearer. The price is significantly below its 200-day moving average, which was between $1.83 and $2.10. That's a classic technical sign of a strong, persistent, long-term downtrend.
So technically speaking,
the picture is unambiguously bearish.
Let's move on to Chapter 5, ownership structure. Who actually owns Aterian?
Well, institutional ownership is very low, typically in the 8.8% to 9.84% range of outstanding shares. That's pretty standard for a high-risk microcap like this.
And who are these institutions? Long-term believers?
Mostly not. The top holders are mainly passive index fund managers. Think Vanguard, BlackRock, Jude Capital. And then you see quantitative high-frequency trading firms like Susquehanna, Citadel, HRT Financial, Two Sigma.
So index funds and quant shops, not exactly long-term fundamental investors placing big bets.
Right. It suggests more short-term trading strategies or index replication rather than deep conviction. It really points to the Aterian being kind of an orphaned stock, lacking that strong long-term institutional backing.
Okay, what about insiders, management and directors?
Reported holdings range quite a bit, somewhere between 7.69% and maybe up to 21.95%. But the critical thing here isn't the percentage, it's the trend of recent transactions.
Which we already flagged.
Exactly.
Yeah.
It's overwhelmingly negative. We keep coming back to this because it's important. Consistent selling by the CEO, CFO, and CTO in May and June 2025. That action speaks louder than the words about the stock being undervalued or the company buying back shares.
A real contradiction there.
A stark one. And because institutional ownership is low and insiders hold a decent chunk, even if they're selling, it means ownership is relatively concentrated.
And the public float is small.
Yes, which means even relatively small amounts of buying or selling can cause significant price swings. High volatility is baked in.
Next up is Chapter 6, risk assessment. Let's lay out a classic SWOT analysis. Strengths, weaknesses, opportunities, threats. What are the internal strengths?
Okay, strengths. They are leaner now after the SKU cuts. That improved gross margin, hitting 62.1% in 2024, is a real strength. They do have recognizable brand assets, especially Squatty Potty. The management team has proven crisis experience now, and they have an established presence on key channels like Amazon and Walmart.
Okay, internal weaknesses.
Big ones here. Financial instability is key, significant losses, ongoing cash burn. Their capital position is precarious, tiny market cap, limited cash, $14.03 end of Q1. Still heavily reliant on Amazon despite diversification efforts. They lack a truly defensible moat now that Andy's story's changed. And of course, that explicit going concern risk we discussed.
What about external opportunities?
Well, if the turnaround does succeed, there's potential for a massive valuation re-rating from that super low PS ratio. The omnichannel growth on platforms like Temu is an opportunity. They plan to launch new, potentially tariff-exempt products sourced from the U.S. And way down the line, if they stabilize, maybe M&A could even come back onto the table either as a buyer or seller.
And the external threats. These seem significant.
They are arguably the most critical factor right now. Intense competition. We covered how hyper-competitive and fragmented this market is, with low barriers to entry. Macroeconomic headwinds are a problem, inflation, high interest rates squeezing consumers, leading to that softness in consumer demand management mentioned. Cost pressures aren't going away shipping. Materials, platform fees keep rising, and it's hard for them to pass those on.
But the biggest threat of all
Is unquestionably geopolitical tariffs. That single factor looms largest.
The Section 301 tariffs on Chinese goods.
Exactly. Historically reliant on China, these tariffs could just obliterate their profitability. It's why they pulled their 2025 guidance. It is, without exaggeration, an existential threat.
And their response is that aggressive plan to shift sourcing out of China.
Yes, accelerating the goal to get under 30% sourced from China by the end of 2025. Management themselves have basically said the success of that plan is critical for the company's survival. The stakes are incredibly high.
Okay, let's bring it all together. Chapter 7, Conclusion. Let's synthesize everything we've discussed. What's the bull case here? What are the arguments for investing in Aterian?
Okay, the bull case. Number one, there's a turnaround underway. You see it in the SKU rationalization, the improved gross margins, the reduced cash burn. Number two, the stock looks incredibly cheap on a price-to-sales basis, around 0.13, suggesting huge potential for a re-rating if things go right. Number three, there's real value in some of their core brands, especially Squatty Potty. And number four, management is sending a public signal of confidence with that share repurchase program.
Okay, that's the bull side. Now, the bear case. The reasons to stay away.
The bear case is equally, if not more, compelling right now. Number one, existential tariff risk. This could genuinely wipe out profitability and is highly unpredictable. Number two, fragile financials. They're still unprofitable, still burning cash, have thin cash reserves, and carry that going concern risk.
Right.
Number three, those contradictory insider actions. Top execs selling while the company buys back stock severely undermines confidence. And number four, hyper-competition and a weakened moat. AME is gone as a differentiator. They lack scale, and the market is just brutal.
So, revisiting that intrinsic value range from the DCF model, it was wide, $1 to $2.50 per share. Still feels like modeling smoke.
It absolutely is an exercise in modeling extreme uncertainty, but it frames the debate.
And Aterian's current share price, $1.46, falls smack in the middle of that range.
It does, which highlights just how contentious this stock is. The current price doesn't offer any significant margin of safety based on that modeling. It reflects the deep division between the potential turnaround story and the severe risks.
So the final outlook, what kind of investment is this really?
Look, this is not your typical stable, predictable value investment. Investing in Aterian today is a high-risk, potentially high-reward speculative wager. You're betting on management's ability to navigate incredibly complex turnaround while facing powerful, unpredictable external threats, especially those tariffs.
It really feels like a binary outcome is possible here.
That's a good way to put it. Significant upside if they pull it off, versus a very real risk of losing most or all of your capital. They don't.
So a final thought for our listeners to ponder.
As you think about Aterian's future, maybe ask yourself this. In this high-stakes game, what really holds more power in the end? Is it an adept management team fighting tooth and nail for survival? Or is it those unpredictable global forces, like tariffs and consumer sentiment, that can completely rewrite a company's destiny overnight?
That was another deep dive, folks. We really hope you found this analysis of Aterian useful.
Yeah, lots to unpack there.
Definitely. If you did find it helpful, please remember to like and subscribe to Stock Analytics AI. It really helps support what we do. And remember, for just €4.99 a month, members get priority access to deep dives on specific tickers.
And we've got that big S&P 500 project coming up over the next few months. Members get exclusive insights there first.
Absolutely. And if you have a specific stock you'd like us to cover in a one-off deep dive, just drop us a super thanks. We do take those requests.
Okay, now for the important disclaimer. Please remember, this analysis was generated by an AI system. It's for educational purposes only.
That's right.
It should absolutely not be considered financial advice. We strongly, strongly encourage you to do your own thorough research, or better yet, consult with a qualified financial advisor before making any investment decisions.
Couldn't agree more. Thanks so much for joining us on this deep dive. Until next time, keep learning, keep questioning, and stay well informed.